good if we go ahead and kick this off and get rolling?
Ready to go. Thanks, Tana.
All right. Well, first of all, I just want to thank everyone for taking some time to join the call this morning. We really appreciate it. My name is Tana Johnson. I'm the Life Regional Sales Vice President for Lincoln Financial, and I support ASA Group and all of their agents on the life cases that they work with. And so in some conversation with Luke and also with Beth, we were talking a little bit about the variable products and the sequence of returns and the index options available and how that's just it's a really good in the climate and the environment that we're in. It's an excellent tool and resource, particularly for retirement income sales, amongst some other designs. But we thought it would be important to obtain a better understanding for those of you on the call as to how the sequence of returns actually works within our variable contracts. And so we are very thankful to have the opportunity to be in front of all of you today. It is my great pleasure to introduce Karen Gilmore-Buxton. Karen is a product specialist with us here at Lincoln Financial. She's been with Lincoln for over 30 years, but particularly as a product specialist and part of that team for the past 15, and is an excellent resource when it comes to our variable products. So she will be conducting the call for us today.
You can get $40 a month.
So we do ask, we're going to not mute the line, so we do ask if you do have to put us on hold. Unfortunately, if you don't mind dropping off the call and popping back on, just so we don't have some hold music, because we will not be muting the lines for this call, so that we can leave it open and available for your questions. But at this time, I'm going to hand it over to Karen. And Karen, are you ready to go?
I am, Tana. Thanks so much for that introduction. And you know, I'm a product specialist for Lincoln, and I get a lot of questions about our VUL products because we are the #1 seller of VUL with 33% market share last year. So this presentation, over the next 15, 20 minutes or so, we want to share a sales idea, and we want to use our unique accumulation VUL product. And the reason it's unique is because it includes features that can significantly reduce sequence of return risk without giving up all of that upside. So for logistic purposes, I would welcome you to unmute your own line. So keep your lines muted. I'm not muting everyone. But if you have questions throughout, please feel free to go ahead and ask the question, or you could use the chat window as well. But we will have time at the end as well for questions. So if we look at industry sales growth year over year through the end of last year, we saw the two products with the most sales growth were indexed UL and variable universal life. And these are the two products that are most commonly chosen, as you know, for accumulation and distribution type needs. So what I'd like to do first is compare the results of a typical design. And we're going to compare indexed UL to variable universal life. We're going to look at a marketplace comparison here. This is for indexed UL in terms of distributions and cash values. And as we can see for this 50-year-old male, standard underwriting class, he's paying $30,000 annually to age 65, and then he's taking 20 years of distributions. And we're assuming withdrawals to basis and then fixed loans. And what you see here are the results of approximately $60,000 plus in annual distributions for these top IUL carriers. And we're also assuming an illustrated rate of return of 6% for these carriers' IUL products. Now, if we look at VUL at 6%, we're seeing a big difference in distribution. So we're seeing 40,000 plus instead of 60,000 plus for the same rate of return. And the biggest reason for that is because with VUL, there are no multipliers or there's some small bonuses, but there's not the significant multipliers that you typically find in the newer IUL products. So the distributions for VUL are typically going to illustrate significantly lower if we assume the same rate of return. Now, if we use a higher rate of return, let's say 8%, which is the default in the software, the distributions are going to be more in line with indexed UL, over 60,000. But does it make sense to run a VUL at a higher rate when we're comparing to IUL? Well, we're going to look at that a little later in this presentation. But first, let's talk about the differences between IUL and VUL. So again, the most commonly used insurance plans for supplemental retirement income are IUL and VUL. And again, both products saw the most growth last year. So which is better for cash accumulation and distribution sales, IUL or VUL? I think it really depends, and it depends on the client. Some clients like IUL because it limits volatility. It minimizes the potential for market loss because of the floor, but it does cap returns. But it does limit that volatility, which is typically the most important thing for the client. For VUL, there are a variety of investment options and unlimited upside potential. So some clients like that option and control. But again, they realize that they do have the possibility of loss. There's no floor typically. But what if there was a life insurance solution where clients could have both? So the option for cap and floor with an indexed account and upside potential with no cap or floor with funds. With Lincoln's AssetEdge VUL, they can have both. They have maximum upside potential during the accumulation years with Lincoln's Elite Series of funds, but they also have that downside protection opportunity during the distribution phase with indexed accounts, because the indexed accounts have a guaranteed 1% floor. And really, one of the most attractive features of Lincoln's AssetEdge VUL are the investment options. There are over 70 to choose from, and they include 15 asset allocation funds. We also have 5 fund of funds. In addition, there are 3 indexed accounts, all with a guaranteed 1% floor, and a fixed account that currently credits 3%, guaranteed at 1. And the feedback that we've gotten from our advisors is that they like the idea of that maximum upside potential during the accumulation years with VUL funds, but then during the distribution years, being able to potentially move that money into an indexed account with a guaranteed floor. So again, there's over 70 funds to choose from. These funds cover most major asset classes. And those of you on the call understand diversification. Many investors understand, don't put all of your eggs in one basket. And all we have to do is look back at the last few years to see which ones were the top performers and which ones were the worst performers. Now, we don't have this updated until next month, so we have 2013 through 2017. So in 2013, about 6 years ago, it was U.S. small cap was the top performer. That was followed by global real estate, and then U.S. large companies. And then in 2017, it was emerging markets was the top performer. The worst performers were commodities and international equities. And interestingly enough, in 2018, the worst performer was emerging markets, even though the previous year it was the best performer. And the best performer last year was U.S. intermediate bonds. So you just never know which is going to be the best performer for any given year, and that's the whole point of asset allocation. And we have those options within our portfolio. So clients can choose investment options from fund managers, well-known fund managers like American Funds, Fidelity, BlackRock, Vanguard, many others. They can also choose individual sub-accounts based on style, obviously like large cap funds, high-quality bond funds, international growth, or if they prefer, they can use our risk-tolerant, our asset allocation models that are based on risk. There are also fund-to-fund options that are invested in specific asset classes. Like we have a dimensional U.S. core equity fund, and we also have a Vanguard total bond fund. So it's just focused on bonds. But what's important about all this is that the client has options. They're not just limited to just funds found in a VUL, or they're not just limited to indexed accounts that you find in an IUL. They have both. And we talked about the investment options for AssetEdge. We know many clients want upside potential of funds during the accumulation years, but what's interesting is that over the past few years, because we've had AssetEdge available since 2015, we've seen clients actually invest about on average, 15% of their premiums into the indexed accounts as well. So they'll put about 85% into the funds and then just a little bit into the indexed account. And I believe that they're looking to limit volatility by having that 1% floor in that portion of their allocation. I've also heard feedback that clients and advisors like the idea of having the option to move out of the indexed account and into the funds at any time in the event there's a change to the indexed account. So we're seeing some cases where instead of buying an IUL, a client will buy a VUL and put 100% of their money in the indexed account. And then if there's a cap change or any change to those accounts, they can move into the fund. So it just gives them more options and control. And then again, having the option at retirement to move out of the fund. So, sequence of return isn't as impactful or as detrimental in the accumulation years. So during the accumulation years, having the money in the funds to have the maximum upside potential, and then during the distribution years, being able to move that into an indexed account with a 1% floor. And we all know the impact of a negative year. But let's look at a scenario. This is a very simple, basic sample. We're ignoring expenses. We're just looking at a non-indexed, so this would be the funds, and what would happen in a distribution and with volatility. So let's assume you're in the VUL subaccount and you have $500,000 in there, and you take a $40,000 distribution. In that same year, there's a 20% drop in the market. Well, the result of that will be account value at the end of the year of $360,000. But let's assume the next year is a good year, and there's 20% growth. Well, that increases the account value to $432,000. And from then on, let's just assume an average 7%. Now, let's look at how an indexed account would react to the same scenario. And the indexed account has a 9.5% cap and a floor of 1% and an initial account value of $500,000. So let's say the same distribution of $40,000, but instead of losing 20% account value, the client's credited 1%. So the end of year account value is $465,000. What about a positive 20% the following year? Would the client get the full 20? No, they'd get 9.5%. And as you can see, if we even assume 5% over the next few years, so 2% lower than the VUL subaccount, the indexed account cash value is still higher even at that lower rate of return. And in fact, it takes a full 10 years for the subaccount to rebound or exceed the indexed account value, even at that higher rate of return. So we all know this intuitively that a significant drop in the early years of a distribution, or any time really during the distribution years, can have a pretty significant impact. That's the value of having that upside potential during your distribution or accumulation years, but having that 1% floor during your distribution years. So the next thing you might be thinking, well, I do have some clients that this might be appealing to, and the next natural step might be to compare the results between an IUL and a VUL illustration. And oftentimes what we'll see is that when you run the VUL and the IUL illustrations, people will use the same rate of return, for example, 6%. And is that the right thing to do? So it's important to understand what's behind the numbers, because there's a lot of differences in the way that the products are structured. Now, we're going to have a couple-minute discussion here on the differences between IUL and VUL in terms of crediting methodology. And just please note that I'm ignoring expenses. This is a very general description. So let's assume a client's interested in purchasing an indexed UL, and the IUL benchmark is the S&P 500. Now, this is a fixed product, so the policy owner's interest crediting each year is simply based on the performance of the S&P 500, not actually invested in the underlying companies that make up the S&P 500. And the interest credited is based on the performance, and it does not include dividends. So for VUL, let's say the client's interested in VUL instead because they really want the control and the upside potential. Well, they're investing in sub-accounts, right, and they're similar to mutual funds. They actually are invested in the underlying companies that are chosen based on the investment objectives of that fund. And the increase or decrease in value is based on the performance. So if the VUL subaccount chosen is the S&P 500 index fund, it does include dividends. So that's some big difference between the two options, in addition to the cap and floor. So let's take a look at the S&P. Again, this is through 2017. The S&P was down about 5%, our S&P fund last year, but this is through 2017, the past 30 years, and this is without dividends, because that's what IUL products are benchmarked to. Now let's look at the S&P 500 that does include dividends. As you can see, you're going to get a higher rate of return. And then finally, let's incorporate the performance assuming a cap and floor. Most indexed accounts have a cap and floor. The AssetEdge VUL indexed account is capped at 9.5%, and the floor is guaranteed at 1%. So if you ignore policy expenses and other factors, the indexed account with a 9.5 cap and a 1% floor, it would have averaged about 6.48% over that 30-year period. And the S&P 500 index that would be available in a VUL contract that does include dividends would have averaged approximately 10.7% over that 30-year period. But you'll also notice something significant is the volatility or standard deviation. For an indexed account, it's very much reduced at a 3.84% versus the over 17% with a VUL subaccount. So it leads back to the question, which rate of return should you run? There's a lot of different opinions on that, but from the feedback that I hear and from what I understand of the markets and the difference between the rates of returns historically speaking, typically 2% difference in the rate of return when comparing VUL to IUL. So why Lincoln's AssetEdge VUL? I mentioned earlier, Lincoln is the #1 VUL carrier, has been for several years. It's primarily due to our guaranteed death benefit VUL1 product, but we also have an accumulation product as we've been talking about. The indexed accounts are guaranteed at 1%, and that's unique. I see a lot of other carriers with a 0% floor. There's a chronic illness rider on this product. For permanent chronic condition, it's an indemnity rider. We have very competitive fund fees, and the reason for that is because the VUL products funds are also shared with our variable annuity block. So there's a lot of assets in those funds. We get break points, and we can pass those savings on to our clients. Another couple of things that I think are important to mention is the premium load is 3.5%. Again, that's the lowest I've seen in the industry. And we also have a 10% DCA enhanced interest rate. So really good opportunity if it's a lump sum or a 1035 exchange, where you're getting a 10% enhanced DCA interest crediting rate on that lump sum in addition to that low first-year premium load. So it's really a great combination. So at this point, that's my prepared comments for today. I really appreciate you joining the call. If anyone has any questions, this would be an opportunity to open it up at this point.